We're pretty upbeat about the outlook for growth in the coming quarters. We think that over the next few quarters, growth should be around 3% or better. Certainly the first quarter was a bad outcome for the US, largely due to the weather, but we think that's a temporary phenomenon, and we see that the underpinnings for good growth are really there. Unemployment's been coming down very fast over the past year or more. It's now at 5.5%. Job growth has been strong over the last 12 months. We've seen job growth of around 250,000 a month, which is pretty good, and we're starting to see signs that the housing market's really repairing. Well, the Fed's currently looking at normalizing its policy rate, and we think they should wait until they see more signs of wage or price inflation than are currently evident before it begins to raise policy rates. Currently, core inflation is only 1.2%, and it's been coming down over the past few months. And really it's a balance of risks argument. If the Fed moves a little bit earlier, it stands the risk of slowing down the recovery. If it moves a bit later, there's a risk of seeing greater inflation. We think the latter risk is probably not as high a priority, and we'd like to see the recovery more entrenched before the Fed begins to move. Having said that though, what's really important is the Fed remains data dependent. Over the next few months, it must watch carefully how inflation evolves, as well as the employment picture and other macroeconomic indicators. And the second thing I'd emphasize is that regardless of the timing of the first policy rate increase, it's very important that the Fed remains gradual in its rate path after that. This year we've done a full financial sector assessment for the United States. It's an exercise we do for the systemic economies once every 5 years. And while we haven't found large systemic risks in the US economy, we do think there are important pockets of vulnerability that will need to be addressed. We've seen more risks moving out of the banking system and into the non-banks, where it perhaps is outside of the regulatory perimeter and less visibility on those risks. We've found market functioning is an issue, particularly when those markets come under stress, as the financial system has adapted post-financial crisis. And the third thing is life insurance. It seems to be taking on more risk and has a weaker regulatory framework than we would like. After the financial crisis in 2008-9, the Dodd-Frank Act, which was legislated by Congress, was a major step forward in improving the financial stability structure of the US regulatory system. As part of that, it created the Financial Stability Oversight Council, which is a coordinating body looking across the entire system and trying to strengthen financial stability. We still think there's some scope to improve that committee. First of all, we think that of the 10 regulators, only 4 right now have explicit financial stability mandates. We feel that each of those committee members could have a financial stability mandate. And secondly, we think there could be a more explicit and clear role for this committee in terms of crisis preparedness and monitoring. And a third thing that Dodd-Frank really didn't tackle was the structure of regulation for the insurance sector. We see risks in the insurance system have been growing over the past few years, and it continues to be regulated at the state level. We see a scope to have a national level regulator that would be able to look at the entire system at once.